So we proceed now to our next topic, which is your adjusting the accounts. Okay, so again, in our accounting cycle, what is our first step? That is to identify and analyze. So we're done with this already. We know what is an accountable event and what is not an accountable event. And then next step is to journalize. So we already know the rules of debit and credit. We know how to make a journal entry, what account will we debit and what account will we credit, and as to the amount. And then we will post them to the ledger. So we're done also. As to the posting to the ledger, you already know when to post it to the ledger and how to post it to the ledger. And then after posting to the ledger, we can now prepare our unadjusted trial balance. So we just said that your unadjusted trial balance is based on the balances of the accounts in your ledger. Next step in your after your unadjusted trial balance is your preparation of adjusting entries. And then preparation of adjusted trial balance. Okay, so preparation of adjusting entries and preparation of adjusted trial balance. So we start first with your adjusting entries. So you already have an idea on what is an adjusting entry. So before we said in your introduction that your adjusting entry is made to split the accounts, split the mixed accounts. Further, to recognize accruals. Further, to recognize accruals. So what are the issues as to your adjusting entries? What are the issues as to your adjusting entry? Okay, so the issues on your adjusting entry is first, of course, your timing issues. So issues for the preparation of your adjusting entries. So first, we have your timing issue. So what is this timing issue? So under your timing issue, remember our periodicity concept or your time period concept, wherein we said that the life of the business is divided into your several time periods. So life of the business is divided in several periods. Okay. So later we will discuss why is it a timing issue. Another, it is an accrual issue. Why is it an accrual issue? So remember our accrual basis concept. So under your accrual basis concept, we said that revenue is recognized when earned. And your expense is recognized when incurred. So when earned, regardless when received, and expense when incurred, regardless when paid. So we don't care if we have received this revenue already, as long as it is already earned, and for expense, so long as we already incurred them, even if it is not yet paid. Okay, so under accrual basis, we recognize revenue when it is already earned, regardless when received. We recognize an expense when it is already incurred, regardless when paid. So why are these issues under your adjusting entry? Because again, we have your mixed accounts. We have your mixed accounts, and your mixed accounts contains asset and expense, and also liability and income. And since they are mixed, under this timing issue and accrual issue, it is said that the expense and the income must be properly recognized at the proper time period. Okay, so why is it a timing issue and accrual issue? Because again, we have here a mixed account, let's say asset and expense, liability and income. So your expense and your income or revenue must be properly recognized at the proper time period. Why? Because again, under our accrual issue, we said that we recognize revenue when earned and expense when incurred. And under our periodicity, you record it based on the proper time period. So here, what happens if we have a mixed account? If that is a mixed account, let's say 90,000, both an asset and an expense. So let's say the 40,000 was already used and the 50,000 was already unused. So on 2019, 40,000 was used, 2020, 50,000 was used, so total is used. If ever you do not split the mixed account, it means that the 90,000 will only be recorded as used on 2020. So it was not properly adjusted or properly recognized in the appropriate time period. So the appropriate time period, we said 40,000 used on 2019 and 50,000 is still unused, therefore it will be used by 2020. Hence, you cannot only recognize the 90,000 as a whole used only on 2020, rather you must recognize them based on the time period. Because again, we said expense is recognized when incurred. You incurred the 40,000 in 2019, the time period is 2019, therefore record in 2019. You incurred the 50,000 in 2020, therefore the time period is 2020, you record it in 2020. So again, what are the issues raised or brought about by your adjusting the accounts? We have your timing issues and your accrual issues. Timing issue, because guys, here, again, we look and record proper revenue and expense at the proper period. In your accrual issue, we need to record the income or expense when it is earned or incurred, regardless when received or paid. Okay, so again, let's say for this example, we have 90,000, which should be recorded on two periods, 2019 and 2020. 2019 because it is incurred in 2019, and a portion was also incurred in 2020. But if you recorded it only as an incurrence of expense on 2020, then we have a problem. Why? Because it is not recorded at the appropriate period, and at the same time, you did not recognize the expense as it is incurred. But you recognize it once you have paid it or once it is fully incurred. That cannot be, okay? Because we need to satisfy these two items. So also before, in your adjusting entry, we learned that your adjusting entry is composed of at least two types. We have your deferrals and your accruals. So under your deferrals, we have your deferred income, also known as your pre-collection. We also have your deferred expense, also known as your prepayment. For your accruals, we have your accrued income and accrued expense. Okay, so take note, in every adjusting entry, we need to ensure that the revenue recognition principle and your expense recognition principle is properly met. At the same time, it is recorded in the proper period. So what is the rule of your adjusting entry? So the rule here is that in every adjusting entry, it will include one income statement account and one balance sheet account. So what is this income statement account? It can be income or expense. If that is a balance sheet account, that is an asset or liability. So what are the accounts that is interrelated in your adjusting entry? So normally, asset and expense goes together for a prepayment. For a pre-collection, income and liability goes together. For an accrued income, we have your asset and income, which goes together. For your accrued expense, we have your liability and expense, which will go together. Okay, so again, in an adjusting entry, we ensure that your revenue and expense are properly recorded at the appropriate time period. And we try to split the mixed accounts. And in splitting your mixed accounts, we have your different account that is used in that mixed account that can either be income or expense and asset or liability. Therefore, in splitting, the rule is in every adjusting entry, it will include one income statement account and one balance sheet account. So using this rule, we further know what are the relationships between the accounts as we are adjusting entry in case of prepayment. We only have asset and expense, pre-collection, liability and income, accrued income, asset and income, accrued expense, liability and expense. Therefore, if that is a prepayment, your adjusting entry can either be a debit to expense or a credit to an asset, and a credit to an asset, or a credit to a debit to asset and a credit to expense. Okay, so for your pre-collection, your entry may be a debit to liability, a credit to income, or a debit to income and a credit to liability. Okay, how about in accrued income? What is your pro forma entry? Your pro forma adjusting entry is a debit to asset and a credit to income. How about in your accrued expense? What is your pro forma journal entry? We debit an expense and a credit to liability. Okay, so guys, here again, we have your different types of adjusting entry, and we look as to the account titles or accounts that we will use in the adjusting entry, whether it is a deferral or an accrual. And then we also set that we have these different pro forma entries as to your prepayment, pre-collection, accrued income, and accrued expense. In your prepayment, you just debit an expense or credit an asset, debit an asset or credit an expense. Sir, what are these entries again? We call them your adjusting entries. We call them your adjusting entries. So all of your adjusting entries will follow this format. All of your adjusting entries will follow this format. Okay, so let's start first with deferrals. So let's learn now your different adjusting entries, and we start with deferral. So what do we mean by deferral? So when we say deferral, we postpone or delay the recognition of income or expense. Okay, so we delay the recognition of income or expense. And under deferral, we have your deferred income and we have your deferred expense. Your deferred income is also known as your pre-collection. Your deferred expense is also known as your prepayment. So what is a pre-collection and what is a prepayment? A pre-collection is a collection of revenue in advance, collection of revenue in advance. While a prepayment is a payment of expense in advance. Payment of expense in advance. Okay, so after defining the two types of deferrals, we learn now the adjusting entry under your pre-collection. So we start first with your pre-collection. Okay, so under your pre-collection, we have two methods of recording your pre-collection. So what are the two methods? We have your liability method and your income method. So what are the differences as to the two methods? The first difference is as to the recognition at the time of pre-collection. If it's liability method, initially it is recorded as liability. If that is an income method, initially it is recorded as an income. Okay, so that's the first difference as to the recognition at the time of pre-collection. The second difference is as to the adjusting entry. So as to your adjusting entry, if we use your liability method, we need to recognize the portion earned. Okay, so if ever that is a liability method in your adjusting entry, we need to recognize the portion earned. But if that is your income method, as your adjusting entry, we need to recognize the portion unearned. Okay, so here again, in your pre-collection, this is a collection of revenue in advance. So there are two methods to record it. We have your liability method and your income method. So when we say liability method, it is initially recorded as a liability, and as your adjusting entry, you need to recognize the portion earned. Now, under your income method, initially, you will record it as an income. And then on your adjusting entry, you need to recognize the portion unearned. So again, if this is the mixed account, it is composed of liability and income. Okay, so the amount of liability is known as the portion unearned. The amount of liability is the portion unearned, and the amount of income is the portion earned. The amount of income is the portion earned. Okay, so to properly understand what is this portion unearned and portion earned, we need to have an example. So our example here in our deferred revenue, so collected 12 months in advance, rent of a lessee, amounting to 24,000 pesos. So collected 12 months in advance, rent of a lessee amounting to 24,000 pesos on July 1, 2020. So today is December 31, 2020. Make adjusting entries. Make adjusting entries. Okay? So first, guys, you need to know what is the amount of the mixed account. So what is the amount of the mixed account? the amount is 24,000. Tama? 24,000. This is good for 12 months. So how much is the per month? This is 2,000 per month. Okay, so we have here 24,000, good for 12 months. So the amount per month is 2,000 per month. So you need to get the portion unearned and the portion earned. So sir, how should we determine the portion unearned and the portion earned out of that amount? So determining the amount of earned, that is the amount that already passed. So this is the period already passed or completed. This one is the period not yet passed or lapsed or completed. Okay? So you collected 12 months in advance on July 1. So you started on July 1. I think we need to change the date so that you will more appreciate the amount of the earned and the unearned. So let's make it October 1. So October 1, so 10/1/20. Today is December 31, 21. So how long is the period, has the period on this particular pre-collection pass? So ilan na yung earned natin? Kailan nagsimula guys? October 1. Anong date ngayon? December 31. So ito na yung lumagpas, di ba? So ito na yung lumipas from October 1 to December 31. So October, November, December. So ilan yung period earned natin? 3 months. Kung 3 months yung period earned natin, ilan yung period unearned natin? So magiging 12 months less 3 months. Ilan yung period unearned natin? 9 months. Now guys, after knowing the period unearned, ang next na kailangan ninyong alamin is yung amount. So we have here 24,000, di ba? Good for 12 months. 24,000 divided by 12 is 2,000 per month. If the unearned is 9 months, then you just multiply 9 months to the amount per month. So times 2,000 per month. So 9,000 times 2,000 will give us 18,000. Here in our earned, we have here 3 months. So you just multiply 3 months to 2,000. So you will get 6,000. So 24,000. Ano nangyari doon sa 24,000? Nahati na natin siya. Anong tawag natin doon sa unearned uli? This is the portion of liability. And then the 6,000, which is earned, this is the portion of revenue. Okay, so balikan natin yung kanina. Sabi natin, the mixed account is composed of liability and income. The liability is the portion earned and the income is the portion, liability is the portion unearned and the income is the portion earned. So here in our example, we collected 12 months in advance worth 24,000. The portion earned is 3 months, October 1 to December 31, 2020. And then the portion unearned is equal to 12 months less 3 months. So we have 9 months. So 9 months times 2,000 is equal to 18,000. Sir, saan mo nakuha yung 12 months? Yan yung term kasi. Di ba? Ang sabi dito, it is good for 12 months. So doon natin kinuha yung 12 months. Now, after we try to split, we try to make our adjusting entry. So for you to properly understand the adjusting entry, you just need to know the method. So first, you have your income method and your liability method. Okay, so income method and your liability method. So what did we say a while back? At the initial measurement, initial recognition, under income method, the pre-collection is recorded as an income. And under liability, the pre-collection is recorded as a liability. Okay. So here, we have a pre-collection as an income and pre-collection as liability. Since it is a collection, what is your entry? So debit cash, kasi nga nakakolekta ka. At what amount? 24,000. So pareho yung may debit na cash na 24,000 kasi nga pre-collection. So nakakolekta ka agad ng cash. Ngayon, ang next na tanong natin is, what is our credit? So ano sabi natin under income method? Income method, initially, it is recorded as an income. So anong entry mo din dito? Credit, rent, income. Kasi nga, i-record mo na daw agad siya as an income. Paano naman sa liability method? So it is initially recorded as a liability. So ano ang credit mo? Credit to unearned rent. Okay. So unearned rent is an account, is a liability account representing the unearned portion of a pre-collection. Okay, so ulitin natin guys ha. Under income method, ang initial entry mo, ang gagawin, yung pre-collection, i-record mo as income. Kaya nga dito ay rent income. Sa liability method naman, yung income mo, initially, i-record mo as unearned rent income. As unearned rent income. Kasi nga, i-record mo siya as a liability. Okay. How about in our adjusting entry? How about in our adjusting entry? Sabi natin, under income method, you need to recognize the amount of the unearned. Dito naman, under liability method, we need to recognize the amount earned. Okay. So, anong sabi natin kanina? If ever, liability yung na-record mo, ano yung pro forma entry mo? Ang pro forma entry mo dapat dito ay i-debit to income and a credit to liability. Kung initially, ni-record mo siya as liability, ano naman ang pro forma mo? I-debit to liability and a credit to income. Kasi nga sabi natin, under your pre-collection, ang magkasama dapat ay income at saka liability. Under pre-collection, sabi natin kanina, ang magkasama dapat ay income at saka liability. Ngayon, gawin natin yung ating adjusting entry. So, we recognize the amount of the unearned. Ano daw yung pro forma dapat natin? Pagka ganito, we debit the income. So, ano yung income na na-recognize natin? Rent income. And then, we will credit the liability. So, ano yung tawag natin sa liability? Unearned rent income naman. And then, we need to recognize the amount of the unearned. Magkano yung unearned natin, guys? So, balikan natin dito. Unearned is 18,000. Unearned is 18,000. So, dapat ang ilalagay natin dito, debit rent income, credit unearned rent income, 18,000. Okay? Sabi kasi natin sa adjusting entry niya, you need to recognize the amount of the unearned. So you debit income and you credit liability. How about your adjusting entry under liability method? You need to recognize the amount earned. So you debit a liability and you credit an income. So what is the liability here? We debit the liability down. What is the liability? It's known as your unearned rent income. And then we credit an income. What do we call our income? Rent income. At what amount? The amount earned. So we go back. We have here 24,000. The amount unearned is 18,000. The amount earned is 6,000. So magkano din ang ilalagay natin dito? 6,000 pesos. 6,000 pesos. Okay, let's examine that whether we use income or liability method, we achieve the same amount. So we have here rent income and unearned rent. We also have here rent income, and unearned rent. Okay? Rent income and unearned rent. Okay, so we start first with your income method. Ano yung initial entry natin? Debit, cash, credit, rent income. So, ika-credit mo daw yung rent income ng 24,000. Tapos, anong ginawa natin doon sa adjusting entry mo? Debit rent income, 18,000. Credit unearned rent income, 18,000. So, kunin natin yung balance natin. Kunin natin yung balance natin. 24 less 18,000, 6,000. Tapos, unearned rent, 18,000. Punta naman tayo sa liability method. Initially, it is recorded as liability. So, you need to debit, cash, credit, unearned rent. So, unearned rent at 24,000. And then to make the adjusting entry, you need to recognize the amount earned. Therefore, we debit liability and we credit income. So, anong ginawa natin? We debit the unearned rent income ng 6,000 and we credit the rent income as 6,000. Magkano balance ng rent income? 6,000. Magkano balance itong unearned rent? 24 less 6, 18,000. So as you can see, guys, whether we use your liability method or we use your income method, we will still yield the same. So what are the steps again? If first you recognize it as a liability, subsequently, you need to recognize the amount earned. Okay? But if you initially recognize it as an income, subsequently, you need to recognize the amount unearned. Okay, balikan natin. So, income method, initially it is recorded as an income. In your adjusting entry, you recognize the unearned. So, under income method, you recognize first an income, then recognize the amount unearned. Next, under liability method, initially, you recognize it as a liability. And then on your adjusting entry, you need to recognize the amount earned. Therefore, liability, and then you recognize the amount earned. Okay, so in short, guys, what is the initial entry under your liability method? Lipat natin dito. Sige, burahin natin. So we have your liability method and then your income method. Initial account use. What initial account we use in your liability? Liability account. In your income, income account. And then, what is our adjusting journal entry account? If initially you recognize a liability, subsequently you recognize an income. If initially you recognize an income, subsequently you recognize a liability. And as to amount, if that is a liability method, the amount that we will recognize is the amount earned. While if that is an income method, we need to recognize the amount unearned. Okay? So initially, if that is a liability, you record first a liability. On your adjusting entry, you record an income. At what amount? At the amount earned. If that is an income method, initially you record it as an income. On your adjusting entry, you record a liability. At what amount? The amount unearned. Okay. Now, after knowing the first or original entry and then the adjusting entry as to amount, then I can say that we are ready to answer problems with pre-collection. So problems with pre-collection. So some more examples. Example number 2. Receive subscription for 9 months amounting to 27,000 on June 1, 2020. Make the adjusting entry as of December 31, 2020. So receive subscription for 9 months amounting to 27,000 on June 1, 2020. Make the adjusting entry as of December 31, 2020. Okay, so first, we need to determine the mix amount. So the mix amount is 27,000. This is good for 9 months. So how much is per month? So per month is equal to 3,000. And then we need to know the portion earned and the portion unearned. So what is the portion earned? The date that already passed or lapsed. So what is the date that lapsed? We have June 1 until December 31. June 1 until December 31. So June, July, August, September, October, November, December. So this is 7 months. While your unearned is equal to your total months, which is 9 months, less the earned of 7 months. So this is only 2 months. So what is the value of our earned? 7 months multiplied by 3,000 is 21,000. What is the value of our unearned? 2 months times 3,000 is equal to 6,000. 2 months times 3,000 is equal to 6,000. After that, we are ready to recognize under your income method and liability method. So we start now our journal entry as to our income method. Okay, under income method, what did we say? You initially record an income account. So your debit here is a cash and a credit to income. So we have subscription income amounting to the amount of our subscription received, 27,000. And then we will make our adjusting entry. So in our adjusting entry, if initially you recorded an income account, what will you recognize on your adjusting liability? Since you will recognize a liability, you credit a liability. We call that unearned subscription income. Unearned subscription income. And then, of course, you need to remove the other account, which is the income. So debit, subscription income. Next question, at what amount? The amount that you will use is the amount unearned. So what is the amount unearned? 6,000. So credit 6,000 for your unearned subscription income. Debit subscription income 6,000. That is under income method. What if we use your liability method? What is your entry? Initial account that you use is a liability account. So you debit, cash, credit, unearned subscription income. Unearned subscription income amounting to the amount of our transaction. Next, we will make our adjusting entry. So if it's initially recorded as liability, what will we recognize? An income. So you need to credit subscription income. And then you need to debit the liability initially recognized. That is your unearned subscription income. At what amount? The amount earned. At what amount? The amount earned. So what is the amount earned? 21,000. So this is 21 and this is 21. Okay, so let's check the T accounts. So this is under income method. And this is your liability method, T accounts. So we have here your subscription income. And then we also have your unearned subscription income. Okay, so on your subscription income, initially it was recorded at 27,000. And then your adjusting is debit to subscription income, and a credit to unearned subscription income. So what are the balances? The balance of your subscription income is 21. Your balance of unearned subscription income is 6,000. How about for your liability? So for your liability, again, we have your two accounts, subscription income and your unearned subscription income. So our subscription income amounts to, initially, there's no recorded, but the unearned subscription income is recorded at 27,000. And then our adjusting, we deduct or debit unearned subscription income for 21,000 and credit to subscription income of 21,000. So balance is 21,000 for subscription income and 6,000 for unearned subscription income. Notice, whatever method we use, whether liability or income method, we still get the same amount. We still get the same amount, okay? So again, here, what did we do? We just divide the balance of our mixed account to your earned and unearned portion, and we recorded it either in your liability method or income method. So under liability method, what happened again? Under liability method, we first record it as a liability, and subsequently, we need to record an income at the amount of earned, And then, if ever we are using your income method, initially it is recorded as an income, and then our adjusting is a liability. At what amount? At the amount unearned. At the amount unearned. Okay, so that's our second example for our unearned income. Third example, for your own working, you try this number 3. Receive a 2-year subscription on magazine amounting to 96,000 pesos on January 1, 2020. Make the adjusting journal entry under income and liability method on December 31, 2020. Okay, so you try this one. Number 3, receive a 2-year subscription on magazine amounting to 96,000 on January 1, 2020. Make the adjusting journal entry under income and liability method on June 30, 2020. Let's change the date, June 30, 2020. Okay, so you try to solve this one, and then guys, you send through chat the answer on number 3. So you just send it to me privately. Send it to me privately.